And as always, we start with Bitcoin. We see here that last week, bond yields and the US dollar index dropped quite significantly last week, which provided a tailwind for both Bitcoin and equity markets, which helped both of them finish last week higher. We see here that Bitcoin was higher by 8.62% at 22,583. And so far, we actually see that this week, so far into the week, it seems to have given back pretty much all of the gains from last week, trading right close to where it opened the week last week. And we are currently trading at 20,930 at the time of recording. This just to show you briefly the sort of relief in the US dollar. We see here the US dollar dropped the US dollar index dropped 1.33% last week, and that was also in part by the big drop in bond yields. This is the yield on the 10-year note. Again, the dollar got weaker and the assets priced in dollars got a tailwind from it, and that helped both Bitcoin and the S&P 500 finish last week significantly higher. Looking at flows into funds that trade digital assets, and these are publicly traded funds that trade digital assets, so ETFs or closed-end funds. And for that, let's just pop up this this graph courtesy of CoinShares. And here we can see that inflows into digital asset investment funds last week totaled $30 million. And there was also an important correction to the prior week's numbers, and those calculations saw the inflows corrected from 12 million to 343 million, and that's the previous bar here that we can see right below the one for this week. And this is this revision makes the previous week the highest week of inflows since November 2021. So again, this is the image that we're referring to, basically the flow of funds into and out of traded digital asset funds from CoinShares, and we can see the big jump from the prior week and this one. And actually also interesting, we see that now makes 4 continuous weeks of inflows, net inflows into these funds. This is a very encouraging sign, as it suggests that institutional investors are seeing the current prices as an opportunity, and they are stepping in to buy. Now, looking at the week ahead, there are many catalysts that could impact Bitcoin. We get plenty of corporate earnings from the S&P 500, or mostly S&P 500 companies, and we saw what Tesla's announcement did to Bitcoin prices last week. So that's why it's important to keep track on which companies are reporting and if they could have any impact on Bitcoin. We have a list that we're going to share with you at the end of the show, as always. We also have a Federal Reserve interest rate decision that happens tomorrow, Wednesday. That meeting started today. And we get a gross domestic product, GDP reading out of the United States that could indicate that the US is potentially in a recession, depending on the definition. We'll get into that as well. And we also get Bitcoin expirations, options expiration week this week for Bitcoin. And we're going to be breaking all of these down throughout this episode and how they could impact Bitcoin. First, let's talk about this upcoming FOMC meeting, which starts in a few minutes, actually, and it will end in a decision that will be reported tomorrow. Now, again, they're meeting once again today, starting in a minute now, and the market expects them to announce an increase of 75 basis points. This is the overnight rate right now, the rate that's in discussion at the moment, and the rate for which the change will be announced most likely tomorrow. Now, again, just for illustrative purposes, if the Fed does raise 75 base points, it will bring the new rate to roughly about 2.32%. And as we can see, that is basically right around the previous high, which was reached in 2019, right before COVID. And this was essentially the high that, once it got this high, it broke the repo market, and which is essentially the repurchase facility that the Fed has. And basically, as a result of that and COVID, the Fed essentially had to start dropping rates aggressively to respark the economy. But what we see actually is dating back for 20 years, the interest rates have been coming down and making lower lows and lower lows. And the reason why it's so important that, or why the Fed is treading so carefully, is that if the Fed actually wants to overshoot the previous high, it may cause some discomfort in the market because, again, it would be the first time in many, many years since the current rate has surpassed the prior cycle's high. It's hard to tell in this particular graph because it only shows data from 2017. But if this graph were to show data from way back, it would essentially show the line sloping down pretty clearly. And this is why it is very unlikely that the Fed announces a 100 basis points interest rate hike, because it would essentially throw the new rate above the prior cycle's high. And the risk for that to be, for the market to react unpredictably to that new high is, in my view, I believe it's too high. And so that's most likely why many investors in the market in general is pricing in a 75 basis points increase for this week's decision. Now, again, as I mentioned, an increase of 100 basis points would essentially put the new rate above the previous cycle high, and that might tip markets over the edge. The Fed will likely want to see how markets react as we approach that 2.3, 2.4 range, and then tread carefully, perhaps increasing them rates more gradually in subsequent meetings that they have throughout the year. They have one in September and another one in November. So just to summarize, a rate increase of 75 basis points and an indication that the Fed would essentially reduce the size of future rate hikes would be well received by the market. Conversely, a surprise rate increase of 100 basis points would most likely cause the markets to sell off. So that covers the FOMC decision. That interest rate decision comes out tomorrow at 2 p.m. Eastern, and Jerome Powell does a press conference at 2:30. We'll recap this in the What's Ahead section, of course. Now that we've turned the page on the Fed, let's talk for a second about Bitcoin options expiration week. And here you see in our skew dashboard, you see that for the July expiry, there are almost 90,000 Bitcoins worth of notional that in contracts that are set to expire this Friday. And as we've covered here in the past, whenever there is a big expiration week, there tends to be volatility throughout the week and into expiration day, which is Friday. As you can see from this graph, the one on your right will show the distribution between calls and puts. And as you can see, there's a big concentration of contracts right at the 25,000 strike price. And these big concentrations of strike in contracts in a particular strike can sometimes act as a magnet if the prices are moving close to that into expiration day. Looking at the price action that we see today as of Tuesday, it seems somewhat unlikely that price will be gravitating towards that $25,000 strike getting into expiration, but it is still nonetheless important to keep to stay aware of that range as we head into Friday. Now, turning the page from Bitcoin and looking quickly at what the US dollar is doing to Latin America and foreign currencies across the board, as we've been covering in this publication, the strength of the greenback continues to cause havoc globally. And we want to share essentially how that is being illustrated or how that is essentially coming to mainstream media, what kind of news are coming out. The headline you have on your screen is from El Tiempo. This is a Spanish newspaper, and the headline reads, "A strong dollar makes a great deal of Latin American economies shake." So consistent with what we've been covering here over the past few weeks, countries across the globe are struggling to contain inflation, and they're struggling also to contain that inflation from turning into social unrest. Last week, we saw protests break out in Panama, and things have continued getting worse in Argentina and Nigeria, to name a few. In Argentina, as you can see from this headline from yesterday from the Financial Times, the peso has already surpassed over 300 pesos per dollar in the black market. Now, the black market has huge quotation marks. As a refresher, Argentinians face a restriction that only allows them to buy $200 per month US using their local currency at the exchange rate set by their central bank. If they want to buy more, they have to tap into the black market and pay more than twice as many pesos to buy the exact same number of dollars. Now, in Nigeria, the Naira is also collapsing. They are facing similar restrictions than Argentinians to purchase US dollars, and the black market rate is soaring. Now, to make things clear, in most instances, including the two that we just mentioned, the black market is actually the open market. It is the most accurate reflection of the price that a willing person will exchange their currency for another. This is the rate that economists need to look at when they are considering or talking about local inflation. Now, Argentina and Nigeria are both economies in which adoption of digital assets is relatively high, and it should be rocketing higher in the weeks and months to come. We will continue to report on that evolution and the progress of these economies. Now, as always, we wrap up with what's ahead for the week. As we've covered above, the coming week is packed with economic data and market-moving events. As a summary, we get the Federal Reserve interest rate decision, we get Bitcoin options expiration, we get earnings, corporate earnings from Apple, Amazon, Alphabet, Google, Meta, Facebook, and more. Plus, we get a reading for the US gross domestic product that could potentially confirm a recession. We'll get to the dates and times of those in a second, but first, a few words on moving the goalposts. So, we'll explain the graph that's on your screen in a second. Many in the economics community critique the consumer price index. This is the way in which inflation is measured and communicated to the public. Many people understand the consumer price index as a basket of goods that a normal person consumes on average. What they don't pay attention to is how the components of that basket change over time, and they do. The graph on your screen is essentially using the same calculation for CPI that was used in the 1980s and holding that same calculation using today's prices to see what today's CPI would be using the 1980s version of the basket. And as you can see from this chart, it's actually pretty simple. The current CPI, if we were to use the same formula as we used in the 1980s, is actually showing that the current CPI would be twice as high as that of the 80s. And so again, it is being, the changes that have been done to this formula have essentially made it such that the CPI has a lower and lower headline number as the prices run up because of the changes to the basket. Now, even using the official data and looking at the slope of the curves, analysts have been able to show that the current inflation rate on a year-over-year basis is higher than it was in the 1980s. And this is the same graph that we're seeing. It's the same analysts. And as per their comment, they say that essentially the CPI inflation rate is calculated as the year-over-year change in CPI. And again, if we display it in absolute value from 1950 to 2022, the chart is essentially terrifying, as shown on your screen at the moment. Now, similarly on this vein, the upcoming gross domestic product reading in the United States will very likely signal a second straight quarter of negative economic growth. Over the years, a recession had been defined among economists as 2 straight quarters of negative GDP growth. However, there is now a campaign to redefine the meaning of recession such that 2 straight negative GDP readings would not mean that a country is in a recession. And this is a headline that was done from Axios last week. They were just basically corroborating or sharing a message from the White House, which essentially is now making a campaign to redefine this academic definition of recession such that 2 straight negative GDP readings are not considered a recession. Let's just say that the timing is very interesting because there is a pending GDP reading that is going to come out this week, and the Fed is on a campaign to raise interest rates. And so it just feels like very funny timing to try to redefine the meaning of recession. Now, just to bring it back to the normal screen, this is a great example of why it is important to get to the bottom of all official data sources. Sometimes small changes, like the change to the component in a basket, can have a very big and real implication, like misrepresenting or undermining the real inflation rate as if we were, compared to if we were using the same formula, and not making that very clear distinction. Now that we get all of that stuff out of the way, let's go into the earnings announcements and economic events that could move the markets in the week ahead. So today, the FOMC meeting began. We are also just about to get the Case-Shiller Home Price Index, which just shows real estate prices in the United States. Expectation here is for an increase of almost 20% year over year. And later today, we get earnings reports from Coca-Cola, Visa, McDonald's, Alphabet, formerly Google, and General Motors. On Wednesday, tomorrow, we get the big interest rate decision from the Federal Reserve. That happens at 2 p.m. Eastern. That will most likely move the markets. At 2:30 p.m. Eastern, we get a press conference by the chairman of the Fed, Jerome Powell. And we also get earnings tomorrow from Shopify, Meta, formerly Facebook, Etsy, Hilton Hotels, and Qualcomm. Thursday, we get at 8:30 a.m. Eastern, the U.S. gross domestic product reading for the second quarter. That's the one in question with regards to potentially 2 straight negative GDP readings that could signal that the U.S. is in a recession. Again, that debate will probably hit the headlines on Thursday. And we also get initial jobless claims in the U.S. continuing to show job market in the U.S. still seems pretty strong, but it's starting to show some cracks and perhaps signs of future potential weakness. And then Thursday earnings, we get big ones: Apple, Amazon, Intel. Let's remember that Intel launched a new mining chip for Bitcoin, so that'll be interesting. And we also get earnings from MasterCard on Thursday. Now, lastly, on Friday, to wrap up the week, we get the personal consumption expenditures index, which is another way of looking at inflation that the Fed pays attention to. And at 10 a.m., we get the Purchasing Managers Index, which shows temperature check on the production capacity or the production side of the house. And lastly, Friday, we wrap up the week with earnings from ExxonMobil, Chevron, and Procter & Gamble. So with that, we reach the end of today's show. If you enjoyed it, if you learned it, if you laughed, I welcome you to thumbs up it, like it, share it with your friends, and subscribe to our channel. If you don't have a Ledn account, I welcome you to check out Ledn.io and learn how you can start earning the best interest rates on your favorite assets. We also have the best rates on Bitcoin-backed loans if you need dollars and don't want to sell your stack. And our most recent product, the Bitcoin Mortgage, lets you buy a house as big as your stack. Thank you, everybody. Have a wonderful week. It's going to be a very, very big one. And see you next Tuesday.